So we talked about in our last video on this little series about the relationship between risk and capitalization rate. Remember, the higher the risk, the higher the capitalization rate will be to compensate the investor for that additional risk. Now, the other relationship we need to remember is that the higher the cap rate is, the lower the value, right? The higher the capitalization rate, the lower the property's value. I'll give you an example. Remember, the formula for determining the value of an income-producing property is that the value of an income-producing property equals the property's annual net income divided by the capitalization rate. So the income and the rate will then determine the value. So assume that you have one building that has income of $100,000 and you have another building that has income of $100,000. One building trades at a 10 cap, one building trades at a 5 cap. Notice 100,000 divided by 10% means that building is worth $1 million. 100,000 divided by 5% means the other building's worth $2 million. So the same income, the building with the lower capitalization rate is going to be worth more money, because investors look at that building that has a lower cap rate as being safer and more stable, and the rent as being more guaranteed. So the lower the capitalization rate is, the higher the value. The higher the capitalization rate, the riskier the market perceives that building to be, which would then cause the value to go down. So again, 100K at a 10 cap, the building's worth $1 million. 100K at a 5 cap, that building's worth $2 million. So remember, the higher the capitalization rate, the lower the value. So if a building has a higher cap rate, that's because the market perceives that building as being more risky than another building, and that capitalization rate is going to be higher, which mathematically is going to cause the value to come down. That's why I have friends of mine that represent some pretty major retailers like, Sprouts Farmers Market or Trader Joe's or Chipotle. When you represent a big Fortune 100 company like Costco or Wells Fargo, the market perceives those tenants as being very safe, which means the capitalization rate is very low, which means those buildings are worth more money. That's why if you get into commercial real estate and you do like tenant rep, or you represent tenants and finding spaces for them to lease, when you represent a big major retailer like any one of those big Fortune 100 companies, you're going to get a call back pretty easily from a landlord, because landlords want those more stable tenants in the space, mainly because they know the market will then perceive that building to be lower risk, which causes the capitalization rate to come down, which causes the value to go up. So you've heard of people like flipping houses, right? Flipping houses, you buy a house, put some money into it, fix it up and sell it off, right? And make more money. The way you could flip commercial real estate, investment commercial real estate, is basically where you buy a building with maybe no tenants or a bunch of really crappy tenants that are all on month-to-month leases. You get rid of everyone. You're not going to win any popularity contests, but you get rid of everyone. Fill that building with super high quality credit tenants. That building is automatically going to be worth more money because that cap rate's going to go down, which again, mathematically is going to cause the value to go through the roof. So we'll talk to you guys on the next one, but I wanted to share with you the relationship between cap rate and value. In the first one, we talked about the relationship between risk and cap rate. When the risk is high, the cap rate's high. When the risk is low, the cap rate's low. When the cap rate's low, the value goes through the roof. Don't forget to share this video, like and subscribe. Follow me on Instagram. Would love to connect with you. We'll catch you guys on the next video.